While gold has been used in trade for several thousand years, its known use by mankind stretches back much further than that. Gold has been discovered in Paleolithic cave paintings nearly 40,000 years old. Gold jewelry and armor found in Bulgaria has been dated as far back as 400 BC. Gold has been used for thousands of years as a medium of exchange and was first turned into an official currency by King Croesus of Lydia around the year 550 BC. Chinese gold coins have also been discovered that some believe to date back as far as 700 BC. In the late 1400s, the Portuguese began trading gold dust from modern-day Ghana. From the year 1471 until the year 1750, over 11,200,000 ounces of gold are estimated to have been exported from the Gold Coast. From roughly the year 1500 through the year 1650, the Spanish conquistadors were said to have stolen nearly 200 tons of gold from the New World. This included gold from the Inca and Aztec empires. The discovery of gold in 1851 at Ophir in New South Wales led to the Australian Gold Rush. In a little over 40 years, 61 million ounces of gold were found in Australia. During the California Gold Rush, an estimated 750,000 pounds of gold were discovered. In 1696, the Great Recoinage in England produced coins with intricate stamps and milled edges. The new techniques invented by Pierre Blondeau produced a new coin that was difficult to counterfeit. The new design also reduced the incidence of clipping, which robbed coins, and thus their holders, of the true value of each coin. In 1821, England adopted an official gold standard. In 1789, the U.S. Constitution gave Congress the sole right to coin money and the power to regulate its value. The Supreme Court ruled that this power included the right to levy prohibitive taxes against states producing their own currency. The United States began a bimetallic standard in 1792. The ratio of the value between silver and gold was 15 to 1. The discrepancy between the two grew over time, and silver began to push gold out of circulation. This was due to the abundant supply of silver and its lower value, making it more accessible to people of lower income. The Coinage Act of 1834 changed the situation with a new ratio of 16 to 1, setting the mint price of silver below the international price, which effectively removed silver from the standard. This led the United States into a true gold standard. Germany's move to a gold standard in the 1870s contributed to an international gold standard, which existed until the beginning of World War I in 1914. The need to raise money quickly for the financing of war efforts led many nations to suspend the ability to convert money to gold. This was a death sentence for the gold standard. These nations would now be able to print money at will to fund war and expansionist effort, but their currencies would be devalued in the process. The gold standard is very good at preventing inflation, as governments and banks are unable to manipulate currency by the overprinting of money. It also provides stability in prices both domestically and internationally. Trade surplus and deficits between nations were settled in gold. This made it difficult to maintain a trade deficit for any nation, and prevented large imbalances from persisting. The US dollar and the British pound sterling became the global reserve currencies as the growth of the global economy outpaced the gold supply. Stockpiles of gold consolidated in larger nations as smaller countries began to hold the dollar and the pound instead of gold. The 1929 stock market crash, international war debts, and falling commodities prices caused many countries to raise interest rates in an effort to deter investors from converting their deposits into gold. This only exacerbated the growing list of problems in the global economy. Shortly after, in 1931, England suspended the gold standard. Now, only the United States and France had large gold reserves. In 1934, the U.S. government revalued gold to $35 per ounce. Arbitrarily raising the price of gold leaves governments room to print more money based on the increased dollar value of the gold that is backing the dollar. This nearly doubled the amount of dollars that could be obtained by selling gold to the U.S., leading to a further consolidation of gold as other nations began to convert their stockpiles into dollars. The dollar was dramatically devalued, but was the only remaining currency directly backed by gold. The U.S. had a firm grip on the gold market. The monopoly on gold in the United States did not last. After World War II, the outflow of money to war-torn nations steadily depleted the American gold reserves. The Western powers created the Bretton Woods Agreement, fixing the conversion rate of gold at $35 per ounce. The US dollar became the global reserve currency. All other currencies were valued in relation to the dollar, which in turn could be converted into gold. This became an indirect gold standard, which remained in place until 1971. In 1968, the US and several European nations formed what would be known as the gold pool. They stopped selling gold on the London market and allowed the market to determine the price of gold. From 1968 to 1971, only central banks could trade with the US at $35 per ounce. The gold pool was short-lived as member nations began cashing in their dollars for gold. Belgium and the Netherlands converted to gold, and other European nations expressed a desire to follow suit. In August of 1971, Britain requested to be paid in gold. In response, the United States stopped the convertibility of dollars to gold, ending what remained of the gold standard. The severing of the US dollar from gold brought an end to the era of the gold standard and ushered in the age of fiat money. Fiat money is a currency that has monetary value based on the decree of the government, not the intrinsic value of the money itself. Now I will end with a quote from President Herbert Hoover. "We have gold because we cannot trust governments."